Sometimes we might have prepaid revenue that's actually just a part payment, which we call a deposit. So, for example, Choice Clothing makes and sells uniforms for waiters and hotel staff. The following transactions have occurred with a client called Hilton's Hotels. On the 4th of December, Hilton's Hotels is going to order 50 uniforms, and the selling price will be $50 per uniform, and the cost price will be $30 per uniform. Then, on the 20th of December, Hilton's Hotels is going to pay Choice Clothing a deposit of 20%. But on that date, they're not actually going to get any uniforms. So they've given money, but the Hilton's Hotels, the customer, hasn't received anything in return. So that is going to be a prepaid revenue. Even though it's only for 20% of the total, it's still going to be a prepaid revenue. Eventually, on the 31st of January, all 50 uniforms will be delivered to Hilton's Hotels, and the customer will be invoiced, so that will become a credit sale. Let's look at how we treat these transactions. The procedure here is we have on the 4th of December is the order. On the 20th of December, the customer is going to leave a 20% deposit. They're not going to get any uniforms at that date. They will eventually get them though at the end of January. So that's the chain of events. So the first item that came up was on the 4th there was an order, and from previous chapters we've learned that whenever there's an order, what action is required? There's actually no action, because there's no legal obligation for either party to pursue with the contract at this point if it's just an order. So what we're waiting for is some money to change hands, and then we'll have a transaction. So on the 20th, a deposit of 20% is paid by Hilton's Hotels to Choice Clothing. So the deposit of 20%, so the sale is 50 uniforms at $50, which is $2,500 plus GST. That'll be a total of $2,750. So is the 20% deposit on the sale amount, or is it on the total owing? In Year 12 accounting, it's actually just going to be on the sale amount. It's not going to be on the total owing. So that's a rule that we need to follow each time. In VCE accounting, there is no GST on deposits. The deposit only applies to the sale amount. We'll also have a cost of sale of $1,500 because there's 50 uniforms with a cost price of $30 each. So on the 20th of December, we've got some money. So we'll enter this in the cash receipts journal with the details of prepaid revenue. We were given receipt number 86. We got $500, and it won't go in the sales column, it will go in the sundries column. So we'll post that to the ledgers now. We've got $500 cash, which will be a debit. And then instead of recording it as a sale, we send it to a new ledger called prepaid revenue, which is a liability. So a few weeks go by, and on the 31st of January, Choice Clothing actually delivers all 50 uniforms to Hilton's Hotels. So the total sale is $2,500 plus GST. That is now a revenue earned. So whilst we hadn't earned it when we received the deposit, we have earned it now. So what we need to do first of all is transfer out this liability. It is no longer a liability because it's been earned. So we'll do a debit, and that'll balance that ledger out to zero. And the moment that we deliver the uniforms to the customer, that becomes a revenue which we transfer across as follows. Now we need to deal with the rest of the sale. It's a total sale of $2,500 plus GST is a total owing of $2,750, except for we need to deduct the $500 deposit. So basically this debtor will owe us $2,250 once all the uniforms have been delivered. So what we've got now is a credit sale for the remainder, and that goes in our sales journal. We do the date. The debtor's name was Hilton's Hotels. We were given an invoice number. The cost of sale was $1,500, and the sale amount, this is where it gets a little tricky. What we're going to do is put $2,000 there. Now, the sale amount is $2,500. Why are we only putting $2,000? Well, the reason is we've already got $500 sitting in the sales ledger. If we put another $2,500 in, that's going to be a total of $3,000. So what we don't want to do is put $2,500 here, because that would be a total of $3,000. So what we've already got is the $500 here. So really we only need to put another $2,000, and that will equal our total of $2,500. So that explains that amount. GST will still be 10%, but 10% of what? Well, it's going to be 10% of the total sale. And now we have something that looks a bit odd. For the whole year, we've learned that GST is always 10% of the sale, and that looks like it's actually incorrect, but it's actually perfectly correct, because what that's forgetting is whilst $250 isn't 10% of $2,000, it will be 10% of $2,500, which is what we'll end up with $2,500 in here, and the GST will be charged on top of that. That means the total owing by the debtor is the two columns here. So we do 2,000 plus 250 equals 2,250, and that makes sense because the debtor doesn't owe us the full amount. We had to subtract away the deposit, and we got the total owing of 2,250. So we now post those figures. We've got the sale going into the sales ledger for 2,000, and together those two numbers now equal 2,500. We we've charged GST. We haven't collected it yet, so that will increase our liability. And then debtors control will go up by 2,250. We'd also make an entry to the debtors subsidiary ledger, which we won't do here. Cost of sale, we've been doing this transaction for a while. We know that's a debit as an expense, and we have less stock, so that becomes a credit in the asset account.